Hello, my name is Yana and today I want to talk about legal entities, presentation prepared for business tax accounting. Learning objectives. What is business entity, non-tax characteristics, business entity types, sole proprietorship, partnership, limited liability company, corporation, entity tax classification, C corporation and S corporation. When we talk about business entities, we're referring to the type or structure of a business as opposed to what the business does. How a business is structured affects how taxes are paid, liabilities are determined, and of course paperwork. Business entities, organizations created by one or more people to carry on a trade, are usually created on the state level, often by filing documents with the state agencies such as Secretary of State. First, let's talk about non-tax characteristics. Business entity types, the most popular types are sole proprietorship, partnership, general and limited, limited liability company, corporation, and S corporation. First, sole proprietorship. A sole proprietorship is an unincorporated business with only one owner who pays personal income tax on profit earned. Sole proprietorship are easy to establish and dismantle due to a lack of government involvement, making them popular with the small business owners and contractors. Second, partnership. Exists two types, general and limited. Any type of business agreement between two or more people can be considered a partnership. Partnerships don't pay taxes, but they must file IRS Form 1065 and provide each partner with the Schedule K-1 detailing each partner's taxable income for individual tax filing purposes. Partnership can be structured in various ways: limited partnership, general partnership, and joint venture partnership are three ways a company may choose to organize its partnership. Now let's compare limited partnership and general partnership. Business law requires that limited partnership include general partners and limited partners. General partners have unlimited liability for all partnership debts, while limited partners are limited to only the amount of money or property that they invest. General partners usually assume full management control of the entity. General partnership is the company between two or more people to share in its profit and liabilities of a company. This can be an informal, as a verbal agreement made over coffee, or a formalized contractual agreement between partners. Here we can see the general partners has a full management and unlimited liability, while limited partners has no management and limited to only the amount of money or property that they invest. Limited liability company. A limited liability company is a type of business entity form that can be taxed like a partnership, but protects the shareholder from liability beyond their investment. Some of the other major attributes of this type of business entity also include more flexible management style and fewer formalities required by the state law. Limited liability company versus partnership. Limited liability partnership separate the business assets of a company from the personal assets of the owners, insulating the owners from the LLC debts and liabilities. An LLC can function in the same way as partnership does. Losses can be used to offset other income, but only up to the amount invested. The last one is corporation. A corporation entity is a legal entity that is separate and distinct from its owner. Corporations enjoy most of the rights and responsibilities that individuals possess. An important element of a corporation is limited liability, which means that shareholders may take part in its profit through dividends and stock appreciation, but are not personally liable for the company's debts. Corporations are not always for profit. Now let's talk about advantages and disadvantages of corporation. Advantage. First, limited liability. In a corporation, the owner of a company are only liable for the amount of money which they have invested through purchasing shares. This means that if the company goes bankrupt and has no money left to pay back the creditors and lenders, the money invested by its shareholders into the company will be used to pay back the creditors and lenders. Easy available of capital. In corporation form of business organizations, it is relatively easy to raise huge sum of capital through the public. Since the total money a company wishes to raise is dividend into thousands of shares, the price of each share come out to be very small. A small price allows a number of people to purchase the shares of the company. Hence, it becomes easy to raise a big amount of corporation by dividing it into smaller units. The next advantage is easy transfer of ownership, and last one is builds credibility. Disadvantages. There are certain disadvantages of setting up a corporation must consider before getting into it. First, complex process. Setting up a corporation is a very complex process. It takes heavily paperwork to set up a corporate. The owner have a lot of permissions for different regulatory authorities. Next, the most important is double tax. Corporation are taxed 2 times in their income. Firstly, the corporation has to pay a flat corporate tax on its profit, and then the dividends received by the shareholders are taxed on their hands. This makes it less attractive for business owners to set up a corporation. Next disadvantage is conflict of interest. Corporations lack business confidentiality, intensive rules to follow. Now let's talk about entity tax classification. Entity tax classification. A business legal form may be different from its tax form. For tax purposes, entities can be classified as either separate tax-paying firm or flow-through entity. Separate tax-paying entity pay tax on their own income. In contrast, flow-through entities generally don't pay taxes because income from these entities flow through to their business owners who are responsible for paying tax on the income. Now let's talk about flow-through entities and what is separate entity. Flow-through entities, pass-through entities is the legal business entity that passes income on to the owners or investors of the business. Flow-through entities are a common device used to limit taxation by avoiding double taxation. With flow-through entities, the income is taxed only at the owner's individual tax rate for ordinary income. Flow-through entities are commonly grouped into sole proprietorship, partnership, limited, general and limited liability partnerships, and as corporations. Now let's talk about separate entity. In terms of day-to-day business, a separate entity runs separately from the owner, with a separate bank account and transactions, buying and selling products or services or both, and receiving and paying out its own money. A C corporation is a C separate entity. According to Treasury regulations, entities that are legal corporations under the state law are by default treated as C corporation for tax purposes. However, shareholders of legal corporation may qualify to make a special tax election known as S election, called S corporation. For many small businesses, the two options are S corporations and C corporations. C corporation under this United States federal income tax law refers to any corporation that is taxed separately from its owners. S corporations, which generally is not taxed separately. Now let's compare the S corporation with the C corporation. Here is advantages and disadvantages. The main advantage of S corporation is that it avoids double taxation. Then taxed as pass-through entity and no corporate level taxation. Disadvantages of S corporation: first, it's restricted to 100 shareholders. All shareholders must be U.S. citizens and residents. Only one class of stock allowed. C corporation also has advantages and disadvantages. Advantages: more growth available since there are no restriction on the number of shareholders, allows investments by non-U.S. citizens, assets protected in the event of litigation. The main disadvantage of C corporation is that income is double taxed. And second, the shareholders share in the income and pay taxes but don't share in losses. Exists 4 categories of business entities recognized by the U.S. tax system. C corporation, separately tax-paying entity, file Form 1120. S corporation, flow-through entity, file Form 1120S. Partnership, flow-through entity, file Form 1065. And finally, sole partnership, flow-through entity, file Form 1040 Schedule C. Conclusion. Today we talked about what is business entity, what type of business entity exists, sole proprietorship, limited partnership, general partnership, limited liability corporation, and corporations, C corporations, S corporations. We talked about flow-through entities and what is separate entity for tax purposes. We talked about advantages and disadvantages of corporations and entity tax classification. Here is the sources that I used to prepare this presentation. Thank you.